There's one line on a chart that institutional traders, the ones moving millions of shares a day, pay more attention to than almost any other. It's not a moving average. It's not a Bollinger Band. It's volume-weighted average price, and if you're not using it, you're trading without the map that the biggest players in the market are following. Let's change that. VWAP stands for volume-weighted average price. It's a running calculation that shows the average price a stock has traded at throughout the day, weighted by volume. Here's why that matters. A simple moving average treats every price equally, but VWAP gives more weight to prices where more shares changed hands. So if a stock traded 1 million shares at $50 and only 10,000 shares at $55, VWAP will be much closer to $50. It reflects where the real money actually transacted. VWAP resets every day at the open. It's a single session indicator. By end of day, it tells you the true average price that participants paid for that stock during that session. This is the part most retail traders miss. Large institutional traders, mutual funds, pension funds, hedge funds, are often evaluated based on whether they bought or sold relative to VWAP. If a fund manager needs to buy 500,000 shares and they achieve an average fill below VWAP, that's considered a good execution. Above, that's a problem. This means VWAP isn't just an indicator, it's a benchmark. It creates real buying and selling pressure because institutions are actively trying to trade around it. When a stock is trading above VWAP, it means the majority of the day's buyers are in profit. That tends to attract more buying. When a stock is below VWAP, most buyers are underwater, which creates selling pressure as people look to exit. Understanding this dynamic gives you a window into who's winning the tug of war and which side you want to be on. The simplest way to use VWAP is as a directional filter. If price is above VWAP, your bias is long. You look for buying opportunities on pullbacks toward VWAP, and you avoid shorting. If price is below VWAP, your bias is short. You look for entries on bounces up to VWAP, and you avoid going long. This single rule, only trading in the direction of VWAP, can dramatically improve your win rate. It keeps you aligned with institutional flow instead of fighting against it. You can apply this to any other strategy you're running. Breakouts, pullbacks, even scalps. Just add the VWAP filter. If the trade lines up with VWAP direction, take it. If it doesn't, skip it or wait. This is one of the most popular day trading setups, and for good reason. The idea is simple. On a trending day, price will move away from VWAP, but it often comes back to retest it before continuing in the original direction. That retest is your entry. Here's the setup for a long trade. The stock opens strong and pushes above VWAP with conviction. It then pulls back toward VWAP. As it touches or gets close to VWAP, you watch for signs of buyers stepping back in, a bullish candle, increasing volume, a bounce off the level. That's your entry. Your stop goes just below VWAP. For a short, it's the mirror image. Stock opens weak, drops below VWAP, then rallies back up to test it from below. Sellers reject the level. You enter short with a stop just above VWAP. The logic is sound. VWAP acts like a magnet in choppy conditions, but on trending days it acts as support or resistance. Pullback entries on trending days put the odds firmly in your favor. This one requires more patience, but the payoff can be significant. Sometimes a stock will trade below VWAP for most of the morning, then reclaim it. That reclaim, that cross from below to above, can signal a shift in momentum for the remainder of the session. The setup. The stock has been below VWAP. It pushes up through VWAP on increasing volume and holds above it. You enter long, targeting the prior morning's high or a key resistance level. Why does this work? Because all of the morning sellers are now underwater, and the buyers who stepped in at VWAP have the upper hand. That shift creates a new wave of momentum as sellers cover their positions and new buyers jump in. The key filter here is volume. A VWAP cross on thin volume means nothing. A VWAP cross on a surge of volume means conviction. Wait for the real ones. Advanced VWAP users add standard deviation bands, typically 1 and 2 standard deviations above and below VWAP. These function like dynamic Bollinger Bands that are volume-weighted. The first standard deviation band captures where price is likely to spend most of its time on a normal day. The second standard deviation represents an overextension. Price has moved too far from the mean. You can use these bands for mean reversion trades. If a stock pushes to the upper second standard deviation band and shows signs of exhaustion, declining volume, a shooting star candle, a bearish divergence. That's a potential short back toward VWAP. Conversely, a flush to the lower second deviation band can be a buying opportunity, especially on high-quality names in an overall uptrend. This approach works best on range-bound or choppy days when the market isn't trending hard in one direction. A few things to keep in mind. VWAP is most useful intraday. It resets daily, so it's not a swing trading tool. Some platforms do offer anchored VWAP, which lets you anchor the calculation to a specific date or event, like an earnings report or a pivot high. That's a more advanced technique worth exploring once you're comfortable with standard VWAP. VWAP works best on liquid stocks. The more volume that flows through, the more meaningful the VWAP level becomes. On low-volume names, VWAP can be noisy and unreliable. Don't use VWAP in isolation. Combine it with price action, volume analysis, and broader market context. VWAP confirms or denies what the chart is already telling you. It's a compass, not a crystal ball. And remember, VWAP is flat or gently sloping on choppy days and has a clear slope on trending days. Recognizing which type of day you're in helps you choose the right VWAP strategy. Pullbacks work on trending days. Mean reversion works on range-bound days. VWAP is the average price weighted by volume, the level that institutions use as their benchmark. Price above favors longs. Price below favors short. Use it as a directional filter, a pullback entry level, a reversal signal, or a mean reversion tool with standard deviation bands. It's not complicated, but it's powerful. And once you start seeing the market through the VWAP lens, you'll understand why so many professional traders consider it non-negotiable. Subscribe if you're building your trading toolkit. Next up, we're covering Gap and Go, how to trade morning gaps with a real edge. See you in the next one.